Welcome back, investors. Jake here. In this video, we're going to cover a highly requested topic, and that would be kind of a introduction to technical analysis. On my channel, I'm frequently reading stock charts, and people want to know, people new to actively trading, how can they read a stock chart themselves? And before we start looking at charts, we have to first talk about mutual funds and hedge funds because this gives the why. Why does the price of a stock fluctuate week to week, day to day, hour to hour? And a mutual fund is a professionally managed investment fund that pools money from many investors to purchase securities. The hedge fund, the younger brother, is a pooled investment fund that trades in relatively liquid assets and is able to make extensive use of more complex trading, portfolio construction, and risk management techniques in an attempt to improve performance. So mutual funds, for the most part, just buy and sell securities, but hedge funds will do crazy things like short selling, options and leverage, and derivatives. And how many actively managed mutual funds are there in the United States? And there's 6,806. How many actively managed hedge funds are there? There's 3,841. So there's quite a lot. Between the two, there are over 10,000 actively managed, actively trading funds with total assets close to about $30 trillion. So where I'm going with this is that Wall Street day to day drives whether or not the market goes up or the market goes down. Yes, retail investors are important for individual stock positions potentially, and of course a lot of money is in people's retirement accounts like 401ks. But where I'm going with this is that the people on Wall Street just have a lot of money. And they want to make more money by actively trading in the markets. They don't want to just put all their money in passive index funds. And these people are not smarter than you or I. They have to make decisions based on certain parameters. And for the most part, they just hire really smart people to do their trading for them, or these people, these nerds, develop trading algorithms in order for the funds to actively trade their positions. And whether or not it's a human being deciding to buy or sell or an algorithm deciding to buy and sell, there's really only three inputs that lead to a buy or sell decision. Those three inputs are fundamental analysis, qualitative analysis, and technical analysis. Fundamental analysis is what is the book value of the company based on the quarterly earnings statements put out by the company 4 times a year. So 4 times a year, we get the most recent updated numbers of the company's income statement, balance sheet, and cash flow statement. From all of these numbers, there's lots of ways to slice and dice them, such as looking at maybe ratios like price to earnings, price to book value, price to free cash flow, price to sales. From all of these numbers, you can try and determine yourself what is the present value of the company worth, or potentially what is the future value of the company worth, and what do you want to pay for that today. Qualitative analysis is basically what is being said or talked about the company now. What are the intangibles that don't show up on the income statement, balance sheet, or cash flow statement? And on YouTube, finance YouTubers like to focus on qualitative analysis. Inherently, YouTubers are storytellers. And for retail traders, they want to be told a good story about a company before they decide to invest in it or buy it. So people want to know, are company CEOs being hired or fired? Are they, force multipliers for their employees? Does this company offer a great product and service that maybe Wall Street doesn't understand or Wall Street doesn't know yet? Is this company in an emerging industry and has somehow a competitive advantage? And are there any newsworthy events that potentially in the future or today are affecting the stock price? So everything else, not counting fundamental analysis and qualitative analysis, everything else can be explained by technical analysis. So when the stock day to day is going up 2% or down 4%, and there was no news and there was no change in the fundamentals of the company, technical analysis is what is left over. So in this video, we'll cover the basics of how to read a stock chart. And remember, three inputs. It's either newsworthy events, the fundamentals of the company, or just the day-to-day price movements, whether it's a human being making decisions to buy or sell, or a trading algorithm. Day-to-day, what determines if a price of a stock goes up or down? And it's just the price of the stock. So the point I'm trying to make is that when you look at the price fluctuation hour to hour or day to day, it's not occurring randomly. There are inputs either from people or more likely trading algorithms making these decisions based off the patterns on the chart. And you will start to notice these patterns, and then you can successfully navigate through them, navigate through the inputs that you know the algorithms more than likely are trading on. Now, of course, technical analysis is not a science. You can't go to university and get a degree in this and then guarantee yourself a full-time income just trading on it. All of these trends, all of these patterns, they're true until they're broken, unfortunately. So I can't give you any kind of guarantee because a newsworthy event or a change in the fundamentals of the company will break even the most strongest trends on the charts. And people want to know what is my educational background in technical analysis, and I'm entirely self-taught. Almost everything I know I learned for free on the website Investopedia. It's the Wikipedia for all things finance and investing. And honestly, anything you want to learn, you can learn for free on this website. Highly recommend you spend more time if you're interested in learning more about finance and investing. And ultimately, when the share price of a stock goes up or down, it's just kind of a battle occurring between buyers and sellers. And when buyers' pressure exceeds sellers' pressure, the price goes up. Similarly, when selling pressure exceeds buying pressure, the share price of the company goes down. So people tend to have an emotional reaction or panic that when the share price of their stock goes down, their stock is now somehow worth less. And yes, based on the bidding price between buyers and sellers today or this minute, the value did go down, but you should have your own internal metric of what the value of a company is based on the fundamentals or based on maybe how you think the company will perform in the future. In the short term, it's just buyers and sellers having this continuous battle, and the share price will just sort of drift up, sort of drift down. So how can we read the chart to predict these basically meanderings of the stock price up and down, up and down? And let's quick in this video talk about candlesticks, trade volume, simple moving averages, price floors and ceilings, perhaps trend lines, some technical indicators, the two most common being MACD and RSI. I personally like the technical indicator of stochastics. There's also golden cross and death cross events on charts. So if you're not familiar with candlesticks, this is just a point of information that you can get about the share price of a stock, and it's telling you four things. So if it's a green candle, then the opening price, and let's just assume that each candle represents a time interval of 1 day. So if it's a green candle, then the bottom of the box is the opening price of the stock that day. The top of the box is the closing price of that day, and then the wicks on top and on bottom is the highest price the share price got intraday and the lowest price. So let's pretend the stock market opened at 9:30 in the morning at this price. It then drifted down by 11 o'clock. It then shot up huge by 2 p.m. to here, and then by closing bell at 4 o'clock, it closed right here. So this one candle can tell us four things. The same is true for a red candle. Let's pretend at opening bell, the share price was here at the top of the box. Then by 11 o'clock, the share price of the company got as high as here. Then later in the day, the share price kept dropping and dropping. Maybe by 2 p.m., it reached a low that day at the bottom of this wick. And then by closing bell, it got back to here. So you can see, once again, opening price to closing price for that time interval of 1 day. Here is the highest it got. Here is the lowest it got during that day. And for trade volume, you'll often see this on the bottom of a stock chart. If you want to get rid of it, you might even be able to get rid of it. But what it's showing you is basically relative how strong of a trading day has occurred. So here is the stock chart for Facebook or Meta. And on earnings, the share price fell from here to here. And look at how high this bar is on the bottom of the graph, showing you trade volume relative to other days. So you can see some days maybe double what the average is. You can find the average trade volume if you want. But when you see a very high amount of trading activity occurring, if it's a green day, that's good because there's lots of buyers stepping in, lots of sellers giving up as the share price moves up strongly. In this case, though, this is a very large red bar showing very strong selling pressure, which is obvious from the chart. But what you can do with trade volume is that if the stock drifts up, like look at these green days here, on very low trade volume, that can be an indicator that this price movement isn't that definitive. It isn't that strong. Likewise, if there's low trade volume on a bunch of consecutive red days, doesn't really mean it's as strong of a price movement as you might see, for example, here. Simple moving average lines are very important, and the four most common moving average lines are the 20-day, 50-day, 100-day, and 200-day. The reason why is there are about 22 trading days in a month, 64 trading days in a quarter, 128 trading days in a 6-month period, and 262 trading days in a year. So large funds and algorithms will just use these nice round numbers of 20, 50, 100, and 200 to represent what is the average share price of the company over the last year, over the last quarter, over the last month. So all a moving average line is the average of the share price value over the last 20 days. And this will create ideal uptrend stocks and ideal downtrend stocks. So here is the share price for Chevron currently, and you can see the red line is the 20-day, the green line is the 50-day, the blue line is the 100-day, and the purple line is the 200. So when all four moving averages line up like this is a very powerful uptrend. You can see even on Yahoo Finance, they're saying bullish, bullish, bullish. There are algorithms and funds that will only buy uptrending stocks. They want to jump on that train as it's already left and then ride it up as high as it can go. And the same is true for the opposite, ideal downtrend stocks. So for example, here is PayPal. It's fallen pretty far. The purple line is the 200-day moving average, and it's up here on top. And there are certain trading algorithms and large funds that will not touch a stock when it's in a downtrend like this, because once again, if you bought it here or you bought it here, potentially it's just going to go lower. There has to be some kind of level of support, a price floor that other funds are willing to step in first. So the advice I want to give you is don't buy the dip, because often stocks like PayPal will just keep dipping. And large funds and trading algorithms, they know this. So when do you want to buy the dip? And you want to buy the dip when a stock is in an ideal uptrend. Think Chevron temporarily pulling back. However, if a stock is in a clear downtrend based on its four moving averages, don't buy those dips. It's just going to keep creating lower lows, lower lows, lower lows, lower lows, lower lows, lower highs, lower highs, lower highs. The number one piece of advice I can give you as a technical trader is don't buy stocks when they're in a downtrend like this. More than likely, as I said, they're going to keep going down. However, if you want to buy the dip here or buy the dip here on an ideal uptrending stock, I mean, this one tip I can give you alone will probably save you a lot of money and headaches when you buy stocks that are just downtrending potentially over the next 6 months or a year. There are some technical terms you can learn to better spot long-term bullish trends and long-term bearish trends. When the 50-day moving average crosses above the 200-day, this is a golden cross event. When the 50-day crosses below the 200-day, this is a death cross event. So here's an example recently with Lockheed Martin. The green line, the 50-day, crossed above the purple line, the 200-day, and this was a very bullish sign. You can see some very large green candles after this occurred. And the reason why is there are certain large funds that will not buy a stock unless the 50-day is above the 200-day. There is a golden cross event signaling potentially a new longer-term uptrend for this stock is occurring. The same is true for the opposite. So here's a recent stock chart of Oracle, and you can see that this stock was uptrending nicely a really long time. It then peaked at around $100 a share. The stock traded sideways and struggled. And as soon as the 50-day, the green line, got below the 200-day, the purple line, you can see immediately there was a huge sell-off in the stock as people wanted to get out of Oracle. And it's just kind of consolidating sideways at this point. We don't see a true downtrend occurring, but potentially, yeah, this could signal a longer downtrend, but large funds, lots of algorithms won't even touch or trade this until the 50-day can get back above the 200-day. Next thing to know is that there are significant price levels on stock charts that act as psychological barriers to traders. And these prices often happen at whole round numbers such as $40, $50, $60, and there are very strong price levels for individual stocks that can be found at multiples of 50 and 100. Why does this occur? And this occurs, and I'm not making this up, guys, is because these large fund managers will put sell limit orders or buy limit orders at nice round numbers. It's just easier to type into the keyboard. Buy it when it falls to $100 a share, sell it when it gets to $200 a share. Because humans are making those decisions on nice round numbers, trading algorithms then try to anticipate and predict them. So let's look at the stock chart for Google. And Google last year was uptrending nicely, uptrending strongly, and it blew past $2,000 a share, blew past $2,500. But as soon as it got close to about $3,000 a share, this uptrend stopped. It pulled back here, it then had another bull run, and it bounced off of $3,000 a share. So there is a strong line of resistance currently occurring at $3,000 a share because there are large funds that have sell limit orders saying when the share price of Google gets to $3,000 a share, just sell it. So it bounced off it here 2 weeks later, kind of resisted here and here, fell down to 2,500, bounced off it one more time. So now, on the chart, where do you see a strong level of support? And the level of support right here is at $2,500. So if the share price falls here, there are large funds with buy limit orders saying that if the share price of Google gets to 2,500, just start buying it. And this will happen a lot with stocks that they'll just start channeling. They'll just start trading sideways within this range of nice even numbers, such as Google right now between 2,500 and 3,000. Now, if the share price of Google falls below 2,500, this is a bearish move, and potentially what is the next level of support where buyers will step in? Could be down here at 2,000, could be here at 2,250. If Google breaks through 3,000, basically we've cleared all of the large funds' sell limit orders, where is it going to the next nice round number? Maybe 3,250 or 3,500. Aside from reading the chart itself, you can add certain technical indicators. This can give secondary confirmation of price movements, and I'll give you the two most common and then tell you about the one I like the most. And the first one is MACD. This stands for Moving Average Convergence Divergence, and this is built on the relationship between short-term and long-term moving averages to show you basically the momentum of the stock. So if you look down here, I've added the technical indicator to show MACD, and you can watch a separate video if you want to go more in depth about this specific technical indicator. But when the bars are green above this line, the momentum of the stock in the positive direction is increasing at an increasing rate. When it's red, it's increasing at a decreasing rate. Similarly, converse on the other side. So I just wanted to quickly mention MACD, potentially looking for buy and sell signals to enter a stock. The other one that is most frequently used is RSI, stands for Relative Strength Index, and it'll spit out a number whether or not a stock has been recently overbought or oversold. Basically, you could say, is the price too low relative to the recent price movements? Is that an indicator to buy? So looking at this stock, you can see that when it gets above 70, this purple line is shaded green. You could say the stock was overbought. Potentially, I could sell now and then wait for a small pullback and then buy my shares back in. This is RSI. The technical indicator that I like the most and that I recommend to you is called Stochastics. I made a dedicated video to this. I will link it down below. Check this out if you want to understand exactly what is happening with these technical indicators. Last thing to think about before you start actively trading is you might want a game plan. And these are some questions you should be asking yourself before, once again, taking any kind of position. What is your ideal holding period for this trade? Is it a couple days, couple weeks, couple months? Is there an entry signal to enter? Maybe the share price of the stock is being given support by the 50-day moving average or is bouncing off the 50-day moving average. Are you using MACD, RSI, stochastics? When do you want to take profits? When you've hit a certain percentage or maybe a certain dollar amount based on the share price of the stock and maybe lines of support, lines of resistance? What is your take profit method? Are you just watching it yourself and doing a market order, or do you want to have a sell limit order or buy limit order in place? What is your position sizing? This is risk management for your account. I generally don't like going greater than 10% of my active trading accounts when taking a position. Do you have any bailout indicators? Maybe there was news that sounds very bad or a technical level was potentially broken. And what kind of trade is this as far as strategy type? Reversion to the mean based on being overbought or oversold in the short term? Event driven, was there a bad quarterly earnings statement? Momentum, once again, are all the moving averages lined up? And this is an ideal uptrend stock or ideal downtrend stock. Let's now do a live example together on Apple, potentially the most traded stock in the world. And there are two websites I like to use in order to read stocks. You can use whatever website you want. Their features and functionality are all pretty similar. But I just use Yahoo Finance and a website called tradingview.com because the basic service to just look at the charts is free. If you want to pay for the premium subscription, premium contents, you can do that, but I don't bother. And with Yahoo Finance, this is what it's going to look like as a default. So let's change a couple things. The first one here is lines. We want to switch this to be candles. We're now looking at candles. For date range, I think going back about 6 months to a year is pretty nice. We'll stick with a year for now. Let's now add the simple moving averages to once again look at the uptrend or the downtrend. So we'll click here, moving average, and we'll do 20. I'm going to change this to be red and then save it. It's now added the 20-day moving average line. Let's go back to another moving average and we'll make this one green. That's the 50-day moving average. Next moving average is going to be the 100, and we'll go ahead and make this blue. Next indicator, adding another moving average 200, and we'll have this one be purple. So you can see that Apple over the last year has been in a pretty consistent uptrend. It's not beautiful, it's not perfect. Sometimes it does pull back, but you can see that this purple line, the 200-day moving average, has almost been giving Apple price support. Whenever Apple trades sideways or pulls back to this 200-day moving average, buyers just seem to step in and then it goes back up. So that is nice to see that Apple is an uptrending stock given price support by its 200-day moving average. Let's now add the stochastics indicator, because I personally use this one and like this one. And for these inputs, for the oversold, I like to change this actually to 35, and then overbought is 80. And you can shrink this or enlarge this, make this bigger. So let's just zoom in on the recent price movement of Apple. And with stochastics, watch the dedicated video. But when this black line, the %K line, gets back above the red line, the %D line, this is a bullish signal. So if you had taken that signal and decided to jump into Apple, you could have ridden it up through this sweet spot intermediate range to go up here into the overbought range. And sure enough, there was like 10 consecutive green candles where everybody and their mother was buying Apple. And then you could see that the %K fell below the %D. Once it got below this 80% threshold, it's showing seller momentum. And yeah, as the technical indicator shows it falling, Apple is in a way selling off. So on Yahoo Finance, I like to add the stochastics. You can see trade volume right here. You can see moving averages. You can see candles, all very important information. And then I also use the website TradingView. And on this website, I think it's a bit cleaner than Yahoo Finance. And I like adding lines of support, lines of resistance on this website. So when we look at Apple's share price movements, where is the first level of resistance that's pretty obvious? And it's right here. We can go ahead and switch this to be a red color showing resistance. And at $180 a share, Apple shot up, bounced off, went down to here, kept running into this 180 line of resistance, meaning there are large funds out there that have a sell limit order at a nice round number, $180. And it's like a ping pong ball where it gives momentum in the seller's direction. The algorithms pick up on this. There's then a sell-off until some fund says, okay, this is a good time to buy, get back in. Goes back up, goes back down, goes back up, goes back down. It bounced off 180 again right here. So where are levels of support where large funds have buy limit orders? And I would argue that there's a very strong one here. Let's see if we can adjust this number to be 150. So if we go back, we scroll back, we can draw a line right here at 150. And what used to be lines of resistance often flip and turn into lines of support after the share price of the company has broken through that barrier. So when Apple pulls back to close to 150, 150 here, buyers step in, you all of a sudden have momentum in the buyer's direction. So this shot from 150 to 180, which is a 20% price movement in 2 weeks. And if you were an active trader or a swing trader paying close attention to this, you could have ridden this up and made a lot of profit just buying and selling the stock, or more likely buying and selling debit spreads or options plays. The last thing I want to show you with these mega caps is they often have longer term trend lines that go back years and years, guys. So potentially, is there a longer term slope, a longer term trend line giving Apple price support? And I would argue there is, maybe going back to right here. And we can make this line, skinnier, and we'll make it black so it's not as strong. But I think that this right here is a slope that was briefly broken during the COVID crash when everybody was selling everything. But when Apple gets too far above this slope line, the stock then just will trade sideways until it basically catches up. And we can even pivot this a little bit more. And you'll notice now how many points of contact are on this slope. Now, obviously, the slope can change or be broken based on the fundamentals if people just stop buying iPhones and stop buying iMacs. But when you start looking for these longer term slope lines, if you can see them, other fund managers and algorithms also see them. So when a stock just gets too far ahead of this slope line, we'll zoom into the more recent period, I think Apple's going to pull back to either this level of support at 150, but more likely just this slope line, and then there will be buyer's pressure back in the up direction. Okay, everyone, that was my introduction to technical analysis. Hopefully you learned something new in this video. If you guys found this video informative, give me a thumbs up so the algorithm knows it's good. If you have any comments or questions, let me know down below. I love hearing from you guys. Till the next video, take care.